The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
Good morning. Thank you so much for joining us here on Money in the Morning with Mitch Goldberg, and we all thank you at 103.9 LI News Radio, 103.9 FM. So it is a good morning indeed. Couple of things to get into. We first will begin with the major averages. And the major averages yesterday, well, the Dow is up ever so slightly. S&P and NASDAQ pulled back. Today, futures are up 64 points on the Dow. S&P down about 25 points. NASDAQ is having a tougher day, down 118 points. It's a 1% drop. I always like to say it takes about a 1% move in the major averages to really get my attention. 2%, you definitely have my attention, but 1% does get my attention. Everything else is not enough volatility, in my opinion, to really concern me about. Believe it or not, I don't actually look at how the major averages are doing throughout the day. I used to do that more. It turns out it's like the least productive thing you can do. Whatever it is, it is. It has no bearing on my decisions or my future, whatever the market is doing now. It's nice to get a quick snapshot, but I go my merry way. It's kind of like weighing yourself, looking at how the markets are doing, looking at the value of your accounts, every minute of the day or several times a day. It's like weighing yourself. It's like trying to lose weight and weighing yourself several times a day. You eat, you drink water, you sweat, you eat, you drink water. Your weight fluctuates all day long. It's not really a good way to gauge your progress. So I don't think looking at the market, every minute of the day or several times a day even is, it's not really a worthwhile endeavor, in my opinion. Oil is up a little bit, moving closer to the high 70s. It's at 77.83. We'll see if it could get to 80. It's been in a range of the low 70s to low 80s for quite some time. And we'll see if there's a breakout there. A lot of things have changed in the oil market, obviously, with Russia not offline. They're just selling their oil to China and India at very low prices. So anything to get the cash flow going into Russia. And it's really kind of sad that other countries are not on board with us, but that's a whole other story. Let's move to bond yields, because this is going to be a really good place to take the show. We begin the day with the 10-year yield slightly above 4%. I don't want to say solidly over 4% because it's 4.06%. So one little fluctuation, it could be under 4 again. But yesterday it touched 4%, closed out at 3.99% on the day. I'm glad it hit 4% in a way, so I don't have to eat my hat, because I told you all I would eat my hat if the 10-year yield doesn't get to 4% pretty soon. We got there pretty soon. I don't think it's a shock to anybody. The last time yields were above 4% was last November. And when the 10-year yield went to 4%, that's when we saw mortgage rates hit 7%. And the 30-year went up to about 7.38%. Was the high watermark of the cycle for the 30-year mortgage rate. So we are monitoring that very closely, because the housing market right now is incredibly sensitive to small changes in interest rates. About in January, rates went down a little bit in the mortgages, like low 6% range. And, housing sales spiked a little bit. So super sensitive. We are just getting started with the home selling season, and we'll see if sellers are going to get realistic. We'll see if inventory remains low. there's so much that is riding on this year's home selling season. I have a lot of friends who are realtors. I have 4 good friends who are realtors, and they're all eagerly anticipating to have a good season, especially since business has been so slow. I was talking to a friend of mine. He's a mortgage banker at Wells Fargo, and yes, he still has his job. He was a pretty productive top sales guy for mortgages. And he said he was doing, about 15 deals a month, sometimes 13, sometimes 16, but about 15 was a number to shoot for, and he reached it often. And he says he's doing, 2 a month now. So that just gives you an idea of how tough it is. The refi market is shot to kaput. So it's all based on people, moving up to a more expensive house and first-time home buyers. And we know the story about first-time home buyers. There's just not enough inventory. Houses are very expensive for a first-time home buyer. And that's why it's so important to see if inventory is coming up in the market or not. Okay, so we take a look at the whole yield curve. The 3-month is just about 4.9%. The 4 months, going out 4 months, you're getting 5%. 6 months, you're getting over 5%. 1 year, you're getting over 5%. 2 years, you're at 4.9%. 10 year over 4%. So right now, from 1 month all the way out to 30 years, everything is 4% plus. This is a huge deal for the market because it makes a higher hurdle for you to value an investment. When interest rates are higher, you could get more money from a safe T-bill. Now you have to expect more out of your stocks. Now getting that 3, 2.5, even 3.5 or 4% dividend yield is not the most attractive thing when you've got 5% plus on a T-bill. Plus, the T-bills are steady, and that is a really compelling thing in a market where we know nothing is steady. This is just such an unsteady market, and it's really difficult to tell where things are going. And it's, the comfort level for stocks has been greatly reduced. Now, I always like to say, I said this yesterday in a post on social media. If you don't follow me or if you're not connected with me, I'm on LinkedIn, Mitchell Goldberg, AIFAAMS. So Mitchell Goldberg on LinkedIn. And you could also catch my Facebook page, Client First Strategy. I'm on Instagram at Mitch. My Instagram is at InstaMitchG. I post there almost every day as well. And follow me. I'm on YouTube, Client First Strategy. But if you want to take this to a one-on-one conversation or you want some of my specific recommendations, you can reach me through moneyinthemorning.info. It's got my phone number there, my address, email, and there's even a submit button. If you want to send me a question, you just enter your email address, your message, hit send, and I'll get it, and I'll get back to you, and we could set up a one-on-one just to talk. There's no obligation. Just, we'll chew the fat, shoot the breeze, okay? And a little bit of housekeeping. Tomorrow morning, I'm having a very special guest. I'm having James Medore, economics writer at Newsday. He's going to be my special guest. He wrote an article that caught my eye about rising minimum wage and automation. Like raising the minimum wage, is that creating more kiosks at McDonald's? What is that doing to labor? And the question is, was this happening regardless of a rising minimum wage, or is the rising minimum wage hastening that trend? But it's affecting so many people, and we see it everywhere, and it's a big concern for all of us. We're all looking at automation, what it does to the labor force, what it does to the job security of you and the people you know. And it's not just automation for fast food joints. Automation is going up the value-added chain. So it's affecting a lot of people. So we're going to talk about that. It's going to be a fascinating discussion. He's going to come armed with all kinds of statistics and news from the Federal Reserve and other agencies that really follow this. It's going to be an in-depth talk. So stick around. We're going to talk about a couple of things, stocks of the day, like Salesforce.com lifting the Dow. And we're going to talk about Tesla pulling down the NASDAQ and a couple of other things. We're going to talk about buybacks and something that you might not have thought of, fee-based versus brokerage commissions. When you hire a financial advisor, there is a difference, and you should know what they're for. You're listening to Money in the Morning on LI News Radio, 103.9 FM. We will be right back. Please stick around. And we're back. You're listening to Money in the Morning with Mitch Goldberg. We thank you for joining us here at 103.9 FM LI News Radio. A couple of things to talk about. What's been big in the news is this whole stock buyback thing. And if you don't know what that is, corporations generate cash and they pay the money out. Well, they have their earnings, they pay their bills, they pay their employees. Research and development. They do all the things that you do, that a company does. And when they have extra money, they could hold on to the money and build their cash reserves. They could pay you a dividend as a shareholder, right? Or they could do what's called a stock buyback, where the company will say, we're going to buy back, stock. And it's hundreds of billions of dollars every year. Sometimes it gets into the high hundreds of billions of dollars. Some Wall Street analysts expect the number to top $1 trillion this year. And we saw a massive buyback from Chevron. They're going to do a $70 billion buyback, which is a little over 20% of all the shares outstanding. That tells me a couple of things. That Chevron does not see a future of the energy that they produce that's worthy of that $70 billion. So they're going to shrink the company by $70 billion. That's what it tells me. You can interpret that any way you want. But for $70 billion, they could revamp, refineries. They could buy more production. There's a lot of things they could do with that money. And then there's other companies like Facebook announced a big buyback. I think they announced like a $40 billion buyback, which just goes to show you with all the news out at Facebook and all the money they're pissing away on the metaverse. Well, I shouldn't say that. It remains to be seen what kind of return Facebook gets on the metaverse. By the way, the name for Facebook, the company, is called Meta, and Facebook is just now a division of Meta. So Meta is spending a ton of money. Just goes to show you how much money that company still generates, which is why a lot of analysts say the stock is still, it's very cheap at these prices. Oh, but I'm not saying you make a buy or sell recommendation on that. I'm just talking about buybacks. And it's gotten a little bit of controversy. I have my own opinion. I have my own opinion on buybacks. Corporations are private entities. The money that they have on the books belongs to shareholders. And if a corporation wants to buy back their stock, they should be able to do it. It's their money. Corporations before the 2008 market crash bought a ton of stock, and then they bought very little stock in 2009 when the market was down so much. My opinion, it's really not an opinion. This is just plain old fact. Corporate treasurers, corporations are just as bad at market timing the purchases of their stocks as ordinary investors. There was a time when Chevron stock was much lower. There was a time when oil was about zero. Remember, during the pandemic, oil went to negative price at one point. That would have been, and the Chevron stock was way down. That would have been a good time to do a buyback, a $70 billion buyback. But they wait till oil is up and the stock is near a high. So anyway, that's neither here nor there. You are allowed to be wrong with your stock purchases, the timing of them, the prices you pay. So what's the deal here? Should it be, against the law? Should it be taxed? These are a bunch of policy questions that remain open. I think buybacks should be buybacks and leave them alone. It's shareholder money. This is not feel-good money for the general public. It's like if I want to pay down my mortgage, it's almost like I'm buying back my own stock. I look at it that way. I am putting my cash to work to reduce my debt or to give me the benefit of not having to pay interest anymore, for example. So I think you leave the buybacks alone. Having said that, what about the airline industry that did buybacks of about, I'm just remembering off the top of my head, they did buybacks of about $30 billion in the year or two before the pandemic. Then the pandemic hit. The airline industry had to be supported, had to go in life support and get bailed out by the U.S. government for the exact same amount that these companies spend on buybacks. So why weren't the managers of these companies prudent in holding on to that money for an emergency? Now, who could have foretold a pandemic? That just, we have to be reasonable. That is not your, bad weather or things that happened to Southwest Airlines this year. That's an emergency. That's something that you have to have funds set aside for. But pandemic, that's a different story. But oftentimes, companies spend a lot of money in buybacks. And later on, they have issues with not enough spending in R&D, or sales go down, we go into a recession, and they have to start laying off people. And in that regard, it's like, wow, you're laying off people, but you did a buyback. Well, let me just say, the company belongs to the shareholders, not the employees. But you could say, well, but what about, we have to have a responsibility toward the employees. There's a lot of responsibilities that companies have to have. But, sometimes you have to prioritize them. And me as a shareholder, I'm in the stock for the gains. It's nice when the company does things that make me feel good. And in a bull market, that's perfectly fine because the stock's going up. Say, hey, you want to do something for feel good? Go right ahead. Make my day. But what about when the market's going down? I'm not feeling so good about my stock holdings. I have my retirement I want to fund. I manage money for people. They have to fund their retirement. I don't want to feel good about that. I want to feel good that I'm helping my clients do my job. So we could debate this, but ultimately, as a shareholder, the bottom line for me is, if I don't like what a company is doing with its buyback, I could just sell the company. There are thousands of stocks to own. If I think a company's doing something wrong with their cash, if I think a company's not being a good steward of their cash and they're not protecting their future by blowing a lot of money in a buyback, I could sell the stock. That's it. I'm not here to sit and debate whether if a company is right or wrong. I'm like, you know what? If it's not for you, sell the stock. You have to believe in the management of the company that you're invested in. That's the most important thing. It's more important than anything else, is belief in the management. So that's how I see it. So there's a whole thing going on with regard to ESG investing, with regard to companies by the Department of Labor. This is being voted on in Congress to do away with this rule that says companies, financial advisors for large pension plans who have fiduciary responsibility to make shareholders' money, pension plan participants' money, the best they can. It's not a guarantee, but the best they can. But if you focus on a company's ESG rating, environmental, social, and governance rating, then are you putting that ahead of the ultimate thing of profits? And by giving managers the leeway to do that, for some people, that's important. I mean, if you look at like Vanguard or Fidelity or BlackRock, they have lots of investment products that are ESG focused. And if you as a shareholder, as an investor, want to invest in those, you're welcome to. If it's not for you, it's not. I actually wrote an article on CNBC about ESG investing, and it's not everything it's cracked up to be, and it's extraordinarily subjective what you and the next person considers a good ESG investment. So the thing that's going through Congress that Biden says is going to veto just simply says financial advisors for pension plans could use ESG ratings. They could prioritize that over profits. But if you don't like it, you could always use another financial advisor. It's just giving more options, in my opinion. But if you don't like the financial advisor for doing that, you could fire him and go to somebody else. It's their choice, because every pension plan has an administrator that's responsible for making these decisions. In any event, thank you so much for listening. I am Mitch Goldberg. You're listening to Money in the Morning with Mitch Goldberg on 103.9 FM, LI News Radio. I will speak with you tomorrow, and I can't wait. Have a great day.
Securities and investment advisory services are offered through Next Financial Group Incorporated, member FINRA SIPC. Client First Strategy is not an affiliate of Next Financial Group Incorporated. All the views expressed are those of Mitchell Goldberg and Client First Strategy and not those of Next Financial Group Incorporated. Views are general in nature and not intended to be investment advice. Any discussion of individual securities should not be construed as a recommendation or solicitation by our presenters. Next Financial Group Incorporated does not provide tax advice.
The views and opinions expressed